All right, time to consider whether this is Andrew Stotson. I just want to go through a little bit of detail on Evergrande, and I want to try to compare it to a company that we look at in the valuation masterclass, uh, which I'll horribly pronounce, but I call it China Vanke, but I know it's Vanke or something like that. And that's a Chinese real estate company that I want to just compare a little bit to Evergrande. In the Valuation Masterclass Bootcamp and in the Valuation Masterclass, we're constantly going through and looking at companies' financials and comparing them as well as valuing the companies. In this session right now, what I'm going to be doing is valuing or not valuing the company, but looking at the financials of the company. So let's go and look at the financials of the real estate sector first in a little bit more detail. So I'm going to share this presentation. I just want to highlight, this is a research that I do in the Valuation Masterclass, and it's about all the companies in the world. Well, not all of them, but 13,900 of them, which you'll see at the bottom of this diagram. That 13,973 is a number of companies I have in my database I use for my analysis, but also for my own teaching. So let's look at it a little bit. First thing, for all companies in the world, we have a gross profit margin of 28%, EBIT margin of 9%, and a net profit margin of 5.2. Now, this is over, as you'll see in the top of this, over the last 3 years. I figured it's better to look at the last 3 years for the real estate sector just because of what's going on in China. Now, let's now look at the next one. This was all companies and all sectors, but this one is real estate only. How many companies are in it? 524 real estate companies worldwide. And what do we see with the real estate companies? Gross profit margin is about in line, and the EBIT margin is 2 times what a typical company earns. Now, this has to do with the structures of the balance sheet and the P&L of real estate companies. Also, keeping in mind there's 2 main types of real estate companies. One is the type that you would call a REIT, a real estate investment trust, and then another one is an actual real estate company that's building product that it's selling, which is mainly condos and buildings. But here we can see at the bottom, the net profit margin of the real estate sector here is double the overall global sector. Now, what about China? So here we can see the China, all real estate companies. Now, of course, that's not all real estate companies in China, but it's 112 real estate companies in China that we've got in this database. And basically, in this data set, which we use in the Valuation Masterclass, what you can see is that the property companies in China are just a little bit lower on net margin, not a major emergency. So now I'm going to change my view, and I'm going to look at some companies here. And the first one I'm going to look at is Evergrande, and the second one I'm looking at is China Vanke. And here we can see in this data. Now, this is the files that we use in the Valuation Masterclass. And basically, I just want to highlight a couple quick things. The first thing is that these companies are producing interim results, meaning not quarterly, but every 6 months. So I can highlight those yellow ones, and that's every 6 months that we can see there. And we can see also every 6 months on China Vanke, which is the one on the right. Now I'm going to undo that so we don't get distracted by that. And what we can see is that when we compare the revenue in the latest quarter compared to, or the latest 6 months compared to the prior one, it's down a bit for Evergrande, and it's actually up for China Vanke. So that's the first thing that I want to highlight by looking at this. But there's a couple of other quick things to look at. The first thing that's kind of interesting here is that China Vanke, I'm going to highlight this again in yellow, or sorry, Evergrande, you can see has already gone into loss, and that's as of June of 2021. And here, if we look at the other side of that, that's earnings after taxes, right? So if we look at earnings after taxes for China Vanke, what we'll see is that it's come down a bit, but actually not down that much. Now, this is an important point of seasonality that you want to be careful about. Property companies and many companies have seasonality. So you don't necessarily want to compare the current period against the prior. You want to compare year on year. And then the other thing that you'll notice about Evergrande here is that there's some item that's keeping it positive here. Otherwise, it would be a negative item. I don't know what that is right now. I haven't looked into that, but you can see that if we look at China Vanke, we'll see that actually their profitability is pretty good given this challenge. Now let's just look at a couple of other quick things on here in the value model. This is the model we use in the valuation masterclass. So the first thing that we can see is though the total assets of these two companies, actually Evergrande is bigger than China Vanke, but we can also see that the level of cash that Evergrande has compared to the level of cash, well, China Vanke has already got double the amount of cash. And the next one that's the most critical one in a property company is the inventory. Inventory is everything for a property company. In fact, that is the main product that they sell. And here we can see that the inventory is massive. This is, let's say, 1.4 trillion Chinese yuan. And here we can see that it's about 1 trillion here at China Vanke. So a lot bigger amount of inventory, and it continues to rise, whereas we can see at China Vanke, it's been kind of flat. A couple of other things to note here, we can see the amount of overdrafts. This is a key one, and the amount of long-term debt. If we add those two up together, what we can see is that the value is about almost 600,000. Now let's look at the same items here, and what we can see is that if we add the two of them up, we're going to see that the debt level is about 300,000. So about half. China Vanke has about half the level of debt as China Evergrande. And so that's a lot less debt, and that's a significant item. So now I'm going to move into a couple of other quick things. I think that I'm just going to go straight to some ratios so that we can look at the situation of these two companies. And basically, what we can see when we look at these companies in a little bit more detail, I like to look for property companies as the working capital management, meaning basically the inventory days. That's the thing that really matters most to me. And that's basically how long it takes for them to move from starting to construct a project to selling it. And then we have collections after that, receivables, collections. And then basically we have a total cash conversion cycle. And so the cash conversion cycle for China Evergrande has been, let's say on average, it's been about 800. But for China Vanke, well, it's been about 500. Now, you have to be careful. There is some seasonality in this number, but generally what we can see is that it's got a lot lower amount of inventory on its books. Now, I do want to focus on something interesting here, and that is the liabilities to assets. We can see that about more than 80. Now, you can also see that this has been falling for the China Vanke. And in fact, what's happening is the Chinese government is trying to push these guys to start to reduce their debt. And here we can see that reduction happening in China Vanke. And what about here? We can see with Evergrande, they're trying to reduce it, but it's not coming down as fast. But here's the next thing that I like to look at, which is net debt to equity. So let's look at what's happening with net debt to equity at China Evergrande. And we can see net debt to equity was 5, and now it's down to 2.6. That's not bad. Let's look at China Vanke, and we can see that net debt to equity has always been below 1. That's a very conservatively run business, you could say, particularly when it comes to the property sector. So now I'm going to switch and just look a little bit again at the balance sheet of the property companies and what makes them different. So let's look at the assets of the all companies in the world. Again, this is all companies, and we can see inventory of about 10.5. We can see net fixed assets at about 30.7. And here, what we can see is when we look at all property companies around the world, the big thing that we can see is a huge inventory increase, and we can see also a very significant decrease in net fixed assets. Basically, property companies don't have net fixed assets except for their headquarters and branches and stuff, but generally they are manufacturing. Their product is the inventory, which is a condo or another type of building. So let's look at Chinese real estate companies, and we can see that actually 50% of the balance sheet is in inventory. That's a very high level, and the amount of net fixed assets is tiny. So why I want to show you this is that what I teach, for instance, in the valuation masterclass, is the idea of understanding the structure of the balance sheet of an industry before you start to look at a particular company. And I would say this gives us a good picture of the assets of the balance sheet. So let's look at the liabilities side of that balance sheet. Again, we're looking at try to get all companies in the world. This is about 14,000 companies. Now let's look at other current liabilities. Now, normally we don't even look at this number, other current liabilities, but here we're going to talk about it in more detail. The other thing we'll look at is total equity. You can see total equity is almost 40%. So what do real estate companies look like? Wow, that's a big difference, right? That's a doubling in other current liabilities. What is that about? Well, that is customers' down payments and customer deposits. This is where these companies are financed to some extent. Let's say 29% of their total assets are financed by their customers. This is what makes, and I think I'm going to highlight here that this is what makes a property company very different from a typical company. With a property company, as we just saw, the average property company is seeing about 30% of its assets financed by its customers, meaning all of the people who make down payments. Now, if you think about it, most companies finance themselves with a bank and maybe with bonds if they can. But in this case, these guys are financing themselves from many individual buyers. So this also raises the issue. Many people ask the question about what's going to happen to the property market in China and overall economy, the banking system. It could all collapse. On the one hand, you have a strong argument that property demand could slow. These property companies could become financially crippled, and that could also change the sentiment. When people are losing on their property, they may not spend as much. And ultimately, you have a story of a collapsing Chinese economy. But if we look at it at another way, you could say, well, the Chinese government knows that they have millions of people who have put down payments on condos and buildings and all that, and they don't want that to disappear. And they don't want people to feel like their wealth is disappearing. So they have to figure out a way to try to prop that up. And I probably come more from that camp, having witnessed China propping up a lot of things, that it could be that Evergrande actually does not completely collapse the economy. But that's a decision that, we each have to make ourselves as we look at it. For right now, I'm going to say that I don't think the property sector is going to absolutely destroy the Chinese economy. Now, let's go back to what we were looking at, because I want to finish up by looking at the balance sheet of, in this case, the Chinese real estate companies. And what do we find? We find that, in fact, for the Chinese real estate companies, it's not 28.5% of assets that are financed by other current liabilities, meaning the customers. It's actually 36.7. Now, we can also see the total equity went from about 40 down to 27 for just the average globally, but now it's down to about 20. So in other words, Chinese companies are financing their assets 20% from equity. And that is really where there's a lot of risk there in the Chinese companies. So I'm going to switch over for a minute to see if we have any questions. So let me do that right now. And let's just see if we have any questions. If you have any questions, feel free to ask. So Avi says, hi, there's Avi. Nice to see you. Uh, are the reports kosher or were they cooked? Now that is funny, Avi. I suspect that all countries around the world have cookbooks, and Chinese companies probably are no different. I expect that plenty of them are trying to prop things up, particularly right now. I mean, times are really, really tough, and so what happens when times are tough? Honest people tell you the truth. Dishonest people manipulate the story. All right, another question from Michael. Dr. DeFi Roberts, even a government-owned shipbuilder just filed for bankruptcy. Yeah, I think this is an interesting one, Michael, because what it's telling us is that um, the Chinese government is allowing companies. I think the Chinese government is going to allow Evergrande to collapse. And what does that mean? The equity holders are going to lose. Now it's a little bit different when the government is an equity holder, but I suspect that they're gonna allow Evergrande to fall. Now think about the U.S. Sometimes they say too big to fail, and then the U.S. government comes in and bails them out. My expectation is that in the case of China, they're going to let Evergrande fail, and what they're going to do is they're either going to take the assets of Evergrande and distribute them amongst their competitors, or they're going to take the assets of Evergrande and bring them on the government's bad bank or bad asset company and bring them in and then distribute them again to the companies that are competing with Evergrande. But of course, if everybody's financial position gets worse, it gets harder and harder. Now, Michael also said many other property companies are in default. There are many that are in default, but there's also some that are strong. You've seen China Vanke is relatively strong. So here is a chance for the strong to survive. And it's going to be an interesting one. Now, I have to admit that right now, my portfolio recommendations have been overweight the commodity space. And that commodity space basically is partially driven on on the Chinese economy doing relatively well. So let's hope that that works. Anyways, that's my discussion about Evergrande and China Vanke, and also you get to see a little bit about what we teach in the Valuation Masterclass Bootcamp, as well as understand the models and the data that we use in that. Feel free to leave any message or comment, and I will do my best to try to answer it. Have a great day.